And thank you so much for being here for my second quarter of 2021 housing forecast. How is it possible that we're in April? I have no idea. It was about a year ago that we canceled our first live event for the pandemic, as we were all kind of wondering what was going on and didn't want to take any risks. And here we are 1 year later. And people are starting to have live events again. So we're starting to talk about when that might happen. But in the meantime, we are here doing our Zoom calls and our go-to meetings and our webinars on a weekly basis, like we've been doing for a decade, over a decade now. Oh my gosh, more like 15 years. And we'll keep on doing them this way until we can do live events. And also when we do live events, we'll be still doing these webinars. So thank you again for joining me. I'll go ahead and get started. I'm Kathy Fettke, co-founder, co-CEO of RealWealth Network. Every year, in the beginning of the year, I've been doing our housing forecast. And then we just decided recently, how about we do it quarterly, because things have been changing so much and it's just so important to stay on top of it. So I've got some new slides today and I'm excited to share. So I'm going to get off the screen for now and get on to the slides. And just again, the quick disclaimer, y'all know this. Always speak with your accountant and your advisor before investing in anything, whether it's a syndication or buying a property. There will be tax consequences, and you want to know what those are before you purchase. And of course, these past performance is no guarantee of the future. We can't know the future. We learned that a lot in 2020. And there's always risk in any investment, certainly in real estate. So I'm just here doing my forecast, doing my best. Use the information as you like. Don't rely on it. It's just for your own research. All right, so let's get started. And I wanted to shift gears a little bit on this one, on today's webinar and forecast, and just kind of go back to the basics, the fundamentals of investing, for us to remember why we're doing this, not just because we like to add more details to our lives, but because there's an ultimate goal. Some of the benefits, and this is for buy and hold, not flipping, but buy and hold real estate, one of the biggest benefits is leverage. You can borrow up to 80% of the money needed to acquire an asset. And sometimes you can even borrow more than that. And then you have the second form of leverage where somebody else pays that loan off for you. So it truly is the ultimate leverage. Let's not forget about that. We're going to take a look at how that kind of leverage is today. And then of course, cash flow, the extra income after all expenses are paid on that property and the pay down of the loan, you still get extra cash flow. At least that's our goal. Getting harder and harder to do these days, but the goal is to have cash flow as well. And I do want to remind people, and we'll be talking about this, that over time that cash flow tends to increase if you're in a fixed rate loan as rents go up. So even if cash flow isn't stellar today, it can improve over time. And then tax benefits. Wow, you can incredibly reduce your income tax and increase your cash flow with the incredible tax benefits. Now, there are some questions about if some of those tax benefits will change, and they might. We don't want to buy real estate specifically for those tax benefits, but I can assure you that over many administrations, these taxes have not changed. So I don't know if they will this time. The Obama-Biden administration did not take these tax benefits away. So many investors think that it won't happen this time either. But with the bottom line being, we never know what's going to happen there. But so far, the tax benefits of investing in real estate have just far surpassed any others. And then appreciation. This is a bonus. This is a bonus that we get as investors, that asset values have been increasing with inflation. So here you've bought an asset, someone else is paying off the loan for you, get a cash flow, you get tax benefits, and the value goes up. And of course, asset protection is something you don't necessarily get with other investments, but you could put the properties in an LLC and get insurance, things that you might not get on other investments. So with that in mind, let's look at the environment today. And if we're talking about leverage, what kind of leverage are we getting? And we know that interest rates have been on the rise in just the last few weeks, although flattening out a bit. And when you look at this chart, it's a little scary. But when you look at this chart, it's like, wait a minute, what are we panicked about? It's still so low, historically low. Look at those rates. They're just, it's unprecedented. Back when my dad was buying in the 80s, Look at that. Look at that. Interest rates were in the 17, 18% range when my dad was buying real estate. So can you imagine what he'd be saying to us, the kind of advice he'd be giving us today with these kind of rates? So still an incredible time to take advantage of the leverage part of real estate. Doug Duncan, the chief economist of Fannie Mae, he's been on the RealWealth show. You may have heard him. He believes housing is expected to remain resilient despite mortgage rates creeping up. So he's not worried about it, and maybe we shouldn't be either. And as you can see here, he says perspective is helpful. While we forecast some continued upward movement, mortgage rates remain historically low, and I agree. And then this was his forecast in January with, you could see in 2019 rates were higher, then they went down a bit. In 2021, he was predicting them to kind of go down, and they're basically, the Fannie Mae prediction is that they're not going to go up that much. So we'll see, and I tend to think that's true, at least for the next couple of years. With that, when interest rates are low and there's lots of demand and not enough supply, you can pretty much predict that home prices will rise, and they have been. And that, here's the chart just looking over the last 40 years. And we know that we've gone through, all these lines are recessions. There's been a lot of recessions since the 80s, but look at home prices continuing to rise. Now, of course, we had a dip during the Great Recession, but even then, at the dip of the Great Recession, it was about the same price, a median home price, as in the mid 2000s. So that's kind of amazing when you look at the long term, how home prices continue to rise even through recessions. And in this particular recession, which of course was a forced one because people weren't allowed to work, we saw home prices go up dramatically, which was shocking to a lot of people. And we'll talk about why. Of course, I think a lot of you know that already. Now, some people have been questioning, including us, with interest rates going up and home prices going up. Are we still going to get that cash flow, that benefit of owning real estate? And what we're also seeing, along with home prices going up, is rents are rising. So many of the teams that we work with nationwide have been saying it's kind of surprising. We're a bit shocked that even though prices have gone up and interest rates are going up, the cash flow is really not that different because interest rates are still so low, and we're also seeing rents rising. And that's why on this slide by CoStar, the shocking thing that we found in 20, we thought that we were going to see cap rates increase. In fact, they didn't. Look at this in multifamily, the yellow line, cap rates went down in 2020, in a year when there was so much fear surrounding real estate and multifamily. And for those of you new to multifamily, basically a lower cap rate means a higher price. It means somewhat lower cash flow because prices are going up if you're in acquisition mode. What's interesting on this slide is that over time, the single family home is gaining rental share. If you look at this slide here, in the 25 to 34 age range, this purple here is San Francisco. I mean, it's San Francisco. You can tell where I'm from. The single family rental share has been increasing in this younger generation and kind of staying the same in home ownership, but in multifamily, a little bit less in that age group in multifamily, and that percent has gone to single family. So we're starting to see more people choosing single family rentals. And of course, we know that. Age 35 to 44 is the same thing. Look at the market share of single family rentals going up, home ownership in this age range kind of going down, but multifamily staying about the same in that age range. This is from John Burns Real Estate Consulting. And then in the 45 to 54 age range, which is basically kind of the older Gen X, young baby boomers, we are also seeing an increase in single family rentals, but also an increase in multifamily and an overall decrease in home ownership. So that's really interesting data, isn't it? Kind of head scratching, like what's going on there. We know that single family rental occupancy is at a 25-year high. So more and more demand for these single family rentals. And like I said, even though prices are going up, so are rents. These are the biggest landlords, basically, the hedge funds that have bought homes over the last 10 years and strictly for rental. On renewals, they're wanting, it looks like from these numbers, wanting to keep people in their homes. So they're just re-renting, raising rents ever so slightly. But on new leases, when people leave, the rents are going up quite substantially. And that's with, again, the biggest landlords in the country. And who's renting these single family rentals? When we really break it down, again, John Burns has done this for us. He's also been on our show on RealWealth and always a great person to interview. You can see it's not so much the young kids, but 25 to 34 is the largest segment of people renting single family homes. So you could tell they're probably starting home families, they have young kids, they want to have a backyard, maybe they have dogs. But also a very large group of 35 to 44-year-olds. You can see over here, 4 million people over the age of 55 also renting single family homes. And single family versus multifamily, again, you can see here in December of 2019 that home prices were rising kind of steadily, kind of just above inflation. Apartment rents were going up and single family rents a little bit, going up just a little bit less than apartment. But fast forward a year and we see home prices just take off, right? And apartment rents actually decline while single family home rentals rent went up. So again, interesting statistics here. We're in the right business, apparently. So then, as I said on that list of things we want to look at when deciding if we're going to invest in real estate is inflation. We call it appreciation, but basically it's just prices going up, right? So inflation. Now the government says that there's not much inflation. You could see back in the 80s, wow, can you imagine 12% inflation? You go to the store to buy bread and it's 10% higher every year. That's tough, but we really haven't had that in the, since the mid 80s. It's kind of bounced around a bit. And, the Federal Reserve keeps trying to shoot for 2% inflation and not really always hitting it. You could see in 2015, there was like none. And most of us think that's okay. We don't want to pay more for stuff. But the Federal Reserve wants to see 2% inflation, which they consider to be a strong economy. So what's interesting is we don't have the same situation in real estate. It's not bouncing around so much. I mean, a little bit, but mostly it's going up. So we're seeing, certainly after the housing crash, I think the bottom was right around 2012, and it's been going up since. And look at that trajectory in 2020. So we are certainly seeing inflation far, far above the CPI here in our industry in housing. And Goldman Sachs is expecting that to continue, expecting U.S. home prices. Well, they said they're rising at their fastest in 15 years, and Goldman says they'll surge another 7% this year. Of course, that's an average, so there'll be some places that increase in value faster than that and some slower. And of course, that's what we want to pay attention to is where. So what's driving all this? We have certainly gone over this in past webinars for many, many years, but it is the money manipulation. It is something that has really taken off, as we know, this money supply explosion. This is not something that happened when my parents were young, when I was young, there wasn't this kind of money creation. But we also know that in 1970, I think it was 1971, Nixon took us off the gold standard, which kind of made it, it's like if we didn't have to have our money tied to anything, well, we could just print it like crazy, and that's what we're doing. It was ever so slow for many decades, and then, of course, it started to rise right after 9/11, and it's kind of continued since. After the last housing recession, we just really thought we were going crazy with QE and all this money printing, but it's really nothing like what we've experienced in 1 year. It's unprecedented. And what we've seen in the past is this kind of money supply explosion. This much money printing generally drives prices up, not so much in the CPI, at least the way the government reports it, but certainly in hard assets like real estate. Because again, when people are scared that money's losing value because it's becoming less valuable if you just keep printing it, then the things that do become more valuable are the things that we really use and need, the hard assets again. And that's, of course, real estate. And that's not all. There's more coming. We already increased the money supply by 5.7 trillion year over year. I mean, that's unbelievable. $120 billion a month is created in QE and 250 billion a month more coming. So just more and more devaluation of the dollar, which again drives the value of real things up, like real estate. And again, we know more is coming. There's the Joe Biden plan to spend well, at least they're trying to get $2 trillion on infrastructure and jobs, which sounds great and is wonderful for the economy. It's just really important to know that it will probably drive the price of real estate up further, because that seems to be where it goes. And we know this started again a year ago. March 23rd is when the Fed saw the big problem. Shutting down the economy was not going to go well. So that's when they announced this unlimited QE, and you could just see it just explodes. So it's been a year. Well, we're seeing it all across the board, and construction material shortages are expected to continue in 2021 as a result of the pandemic, and that is driving the cost of housing up even further. It's not just the money supply, it's the cost of goods, and labor is going up so much. I believe lumber went up 300%. So those of you trying to buy homes, this is what's happening. This is what's happening, and it's going to continue. So the big question is, where will prices be in 23 years? It's really hard to imagine the future. We're used to today. We're used to today. And when you go to places where prices have never really gone up, like when we started investing in Texas, prices had just never gone up. They might go up 1% to 2% a year, but they didn't experience what I knew in California, which is prices going up 10% almost every year or more. So I was used to an appreciating market. When we went to Dallas, they were not. The realtors we talked to and the people selling property, they couldn't imagine prices going up 3 times. And to them, that would be considered a bubble. But there were other factors at play that kind of show it's really not a bubble, at least not in Dallas, where we started buying 15 years ago. But let's just go back to 1997. This is when Rich and I bought our first house, and we were just kind of coming at that time. It was the beginning of a boom, so we timed it right on our first home. But you can see the prices were already starting to go up, and some people might have thought, "Ooh, it's a bubble. I don't know if I want to buy now. What if it goes down?" And the opposite happened. We see prices just continue to go up. So in 1997, when we bought our first house, could we even imagine the average home price being more than double that? Like, your brain just can't conceptualize that, because you're used to your salary, you're used to what things cost today, and it's hard to imagine what they cost in the future. But I assure you, if this is what's been happening, we almost have to wrap our minds around 20 years from now. If we've never had this much money printing, is it possible that the average home price could be $600,000? I'm telling you, in 97, nobody would have thought that. That was just a amount of money we just couldn't wrap our heads around. And today we're in the same place. The average home price being $600,000, is that possible? Based on this, it is. It is. It's scary. Based on what we're seeing, it could be $900,000. We just don't know, but the signs are there. When you print this much money, money becomes less valuable, and things we need and use become more expensive. All right, so let's go back to the basics of forecasting. I just talked earlier about the basics of real estate investing and buy and hold, and the benefits you get, the leverage, the cash flow, and appreciation. But how do you know that what's coming in the future? How can we really forecast? Is there going to be another housing crisis? Are we in a bubble? What's going to happen if interest rates go up, and so forth. So how do we predict what's coming? And as a home builder, we syndicate, we have 6 subdivisions now. plus we work with builders all over the country to help our members acquire rental properties. We have to be able to know what's coming as best we can. Of course, we can't really know, but we can have a pretty good idea based on trends. And the trends are job growth, population growth, affordability, and infrastructure growth. These are the things we want to pay attention to when forecasting. I've gone over this a lot in my book and certainly on these webinars. Well, what we're seeing right now in job growth is that the world is waking up. Economic growth, this is from Fannie Mae. Again, economic growth expected to accelerate through spring as COVID-19 lockdown restrictions ease. So it's kind of an obvious, if you've shut down the world and you slowly open it back up again, it's going to be pretty robust, right? We're gonna see job growth. We're gonna see numbers like we've never seen. Certainly, we know that vaccines are being deployed. That's having a lot of people feel more confident. And as they get out, the U.S. economy expands with real GDP growth predicted to hit 8.4% in the second quarter and 6.6% for the full year. That's pretty big. And that's bigger than what Fannie Mae just projected in January, just a few months ago. They were thinking 3%, now 6%. That's incredible. And I think it really does have to do with, perhaps the vaccine rollout, or that, numbers are down, cases are down. So whatever it is, we're seeing bigger growth than they expected just a few months ago. And this is an interesting slide that you could see here from Opportunity Insights Economic Tracker, that people who make over $60,000, they've kind of recovered in their job market. In fact, they have more jobs now, and that's really kind of interesting. And then you go into the, you'll see here, less than 27,000, this is the green line. These are the people who really got hurt the most in March, and at the beginning of the pandemic. But as the economy started to open, they started to get their jobs back, but it flatlined. So it's not fully recovered by any means, but getting better. And then you've got sort of the middle income earners, 27 to 60,000 a year. They've gotten most of their jobs back too. It's just down 5%. So again, the world is waking back up again. And imagine, as it does in the summer, as people feel more comfortable going out in the warm weather and so forth, we're going to see some of those jobs, a lot of those jobs come back in hospitality. You can see it's already growing the fastest in the recovery right now as things open up. It got hit the hardest, and it's going to probably rebound the fastest now as things open up. So again, something to pay attention to. Some of those cities that got hit the hardest when everything shut down, like Orlando and Vegas. Well, although Orlando didn't really even get hurt that hard, but Vegas certainly did, and so did New York. As people go back to traveling and going back to events and so forth, it's just going to, wow, we're going to see massive hiring. But in the meantime, the cities with the highest unemployment, Los Angeles, look at that, 11%, still very high. Vegas in second place, and New York, just like I said. So a lot of areas still really struggling in the comeback. But then you've got other areas that have more than recovered. Look at Salt Lake at the top. I'm just, again, so thrilled that our development in Salt Lake City, it's only 15 minutes away from the Salt Lake City Airport, our Park City development. And look at it, it's #1. That area is #1 on the lowest unemployment. It just really has more jobs than a year ago. Jacksonville, another area that we just love, and Tampa, we talk about these two cities so much. They have almost fully recovered, or they're better. Look at that, Jacksonville, even lower unemployment than a year ago. And Tampa too. Indianapolis, another great city. We always talk about Cincinnati. Look at that, even lower unemployment than a year ago, or than a month ago. Sorry, month ago. So these areas definitely improving. Orlando, Detroit, Atlanta, Charlotte, all areas that RealWealth also loves for rental property. And we have great teams in those areas that can help you find property. Well, it's harder and harder to find that property, but they're doing a good job at it. All right, so I talked about job growth as one of the fundamentals for being able to forecast. Also population growth. Well, we already know our US population is growing and has been. And we also know that certain groups are larger than others, and the millennials are a very, very large generation, but so are the Gen Zers. The millennials, this largest group of millennials, as I mentioned in the last webinar, they're in their late 20s, and they're only a few years away from their prime home buying years. But with these low interest rates, many of them are just doing it anyway. They're jumping in because they can. They're, maybe in the tech industry or financial industry, and they're able to buy now, work remotely. So just this huge wave of US population ready to buy homes, or if they aren't ready to buy, they're ready to rent them. Of course, there's a lot of people saying, yes, but what about all the serious delinquencies? We see all these headlines about that. I've talked about this before, and certainly in my January forecast, that the media doesn't always get it right, and they're calling serious delinquencies really just what are forbearances and allowed delinquencies, but they've been called serious delinquencies. So sure, when you look at it like this, it's terrifying, to just see it go up like that. That would normally be a really bad sign. But remember, people were told, guess what? You don't have to pay your mortgage. So if you're not sure you lost your job, or you did lose your job, and you're being told that you can not pay your mortgage and not have your credit dinged for that, and be able to work it out later and maybe pay later, well, you're going to do that. But 86% of the people who signed up for forbearances are able to exit successfully. They're not losing their homes. So all those headlines saying, oh my gosh, all these millions of delinquencies, well, it's not that. In fact, 82% of the forbearances have been extended and will most likely be modified. There's no bank that just wants to put all their assets on the market at low rates and get, nobody wants to get less for an asset. They're not going to flood the market with foreclosures. They're just going to modify the loans. And it wasn't these borrowers' fault that they couldn't work. They weren't allowed to go to work. So at the same time, we know that foreclosures are at record lows. Of course, part of this is because you're not really allowed to foreclose either. So, will there be a bunch of foreclosures when that's lifted? Maybe, and it will probably creep up. But from this low level, what you're going to hear in the news is it doubled, and it's going to scare everyone, but that means it'll just be here. And then they'll say, oh, it doubled again, and it'll just be here. So the news is going to create an illusion that things are bad. But when we look at this chart, it's like, oh my gosh, no, we're not even back to what's considered normal foreclosure activity. So just be aware of that. You're going to see a lot of scary headlines. And for those of you who'd like to buy foreclosures, there will be more opportunity coming soon, but not what you're thinking. Not what you're thinking. It's not, the market is not going to be flooded with foreclosures. And even if they were, even if a whole bunch of properties came online, they would be sold so fast to iBuyers or to people like you and me looking for deals, looking for rental properties. With supply at record lows, we could use a few foreclosures, right? We could use more supply, and there will be a little bit, but it's not going to really move the needle that much. Supply is going to be an issue, in my opinion, for a while. This is 2020. This line right here has just record low supply compared to prior years. And of course, low inventory equals low sales. So you're also going to see headlines saying, oh, sales were down, and everybody freaks out. And oh boy, there's going to be, there's a bubble. But that's not it. It's like simply, if there's nothing to buy, you're not going to have sales. We have, as you know, at RealWealth, about 15 teams that we work with who are so committed to us. They work so hard to find us inventory. And sometimes they just simply don't have it. They have more than a lot of other people have. And if you just go to some random agent, you're going to have a really hard time. You're going to do multiple offers, bidding wars, trying to get these properties. Our teams have set them aside for us, but even so, there's not enough for demand, to meet the demand. And that can lower sales, not because there's not demand, but because there's just not inventory. I mean, that again is unprecedented. And part of that lack of inventory is the slow pace of new construction. It's just been so hard to build. And like I said, in Park City, prices are going up, and it's hard to find workers, and many of the cities have been shut down from COVID, so you can't get your permits quick enough. I mean, the whole process has been difficult. And yet, with all of this in mind, low inventory, higher rates, more demand, shockingly, affordability is still high. higher than potentially in the past. So when we look at now, which is the blue, and compare it to a year ago, January of 20, in many places, it's actually, it's not that different. In some cases, more affordable. So, well, in all these cases, more affordable. So that's shocking because interest rates are so much lower than they were. So this is just an example of the absolute frenzy out there of people desperately trying to buy whatever they can find. This is the increase. Look at that increase in new home purchase sale agreements. And so you've got Jacksonville, just wow, look at that. Massive increase. Chicago, Indianapolis, Cincinnati, again, all the cities that you see so much. These just a big increase in new home sales. In the smaller metros, you can see a lot of these are in Florida. And Reno, we've got another project in Reno, definitely seeing huge demand for homes. So with all of this, it does sound very exciting, an exciting time to get in if you can. Cash flow is still possible in the 5 to 6% return rate, you know, in some of these areas that we talked about. But probably the bigger opportunity is the appreciation, which we don't really generally like to talk about because you just can't. How do you predict appreciation? The way we can predict it now is that if they keep printing money, most likely prices are going to continue to rise along with wages. But what are the risks? There's a lot of risks. I mean, some areas, this is the apartment market cycle. Some multifamily have maybe oversupplied, so you might want to check this out later. You can watch the recording and look at this to see maybe some areas that might be oversupplied in multifamily because with new units coming online. The biggest concern is that we really do predict that asset values will continue to grow, that we will see pretty big inflation in real estate and also with rents rising. So it's if there was ever a time to lock in your low rate, it would be now. If you don't own a home yet, maybe see if you can somehow work remotely and go buy a primary residence in an area where you can afford that and buy it. We could just buy it with 3% down in an area where you may not live forever, but you can live while you're living remotely. And then if you have to go back to your job and back to the city where your job is, you can rent that house out, but you can buy it as a primary residence. So, you know, again, never has there been a better time to lock in these rates and you know, a fixed payment for 30 years, a fixed payment. You know, rents are going up. So if you are currently a renter, you can pretty much predict your rents are going to go up. But if you buy a house and you lock in your mortgage, the rents don't go up. You've got a fixed rate mortgage for 30 years. And the same is true if you're buying that property as an investment. You're locking in that 30-year fixed rate for, again, 30 years, same payment, but you kind of know rents are going to go up over 30 years. So that's how your cash flow increases in an environment like this. Debt will probably be cheap, but eventually rates will go up. It will be a few years. And at that point, the housing market will slow down a bit, like we've seen in the past when rates went up. But specifically in areas where affordability is being challenged right now, where the average person is having a hard time buying the average home, you're probably going to see more problems there in terms of a slowdown in home prices. Whereas in areas where it is more affordable, it doesn't matter so much if rates go up because it doesn't change the payment that much in areas where it's affordable. So again, bottom line, the divide will grow. This is good for people who have assets. It's not good for people who don't. It breaks my heart that it's going to be harder and harder for people to do this, to do what we promote, to acquire real estate. It's just going to get harder. And so if you can do it, do it. I know a lot of people are still waiting for that foreclosure crisis, and you might be waiting a while. So just, you know, be careful. But of course, never over leverage either. You want to make sure you have plenty of reserves I like to see 6 to 10 months of mortgage payments in a reserve so that if you have vacancies, you can carry, just kind of carry that property through it. It's super important. Or if you have unexpected repairs, you need to have that money set aside. And as long as you do, at least in the past, we found that even if prices went down, even in 2008 when home prices, well, 2009 is really when they declined so much, but people who owned rental properties weren't necessarily affected because they weren't selling. If they had to sell, that was a problem. If they didn't have enough reserves on hand, then it was a problem. But if they did have enough reserves, then they just continued renting those properties. As people went into foreclosure and lost their homes, they became renters. So rental demand actually increased at that time. So even if the asset value went down, the investor, the landlord, was potentially getting a raise, making more money as rents went up, as demand increased for rentals. So again, an important thing to remember. And this is why we are on such a mission at RealWealth to help people create real wealth, which is having enough passive income that you can spend your time the way you want to with the people that you want to spend it with. So really, real wealth is having the time and the money to live life the way you want to. And we do this by helping you acquire cash flow real estate in growing markets through our turnkey model. So if you don't know our website that well, you just log in. You can find all the areas where we have teams here under single family rentals. You want to be pre-approved with a lender and ready to go before contacting any of these teams. They're not going to hold property for you. You have to have your pre-approval letter. You got to show your source of funds. If you have general questions about investing, just contact us. Just sign up for an investment counselor. Reach out to us, ask questions here or on our webinars, but don't reach out to the teams till you're truly ready to buy, because they sell properties in a day. They're not going to be able to answer your questions or hold property for you. So come to us for those questions and go to them when you're truly ready to buy. All right, so let's go to the questions. I'm going to come on back to the screen so I can see you. Hello. And let's take a look at the questions. All right, where do we get the best interest rate to refinance a rental property? I'm going to go back to this slide if I can. I don't know if I can. Well, anyway, on our website, you'll see Invest tab, and there's resources there, or talk to an investment counselor at RealWealth. There it is. You can see investor resources there on the right, and click on that, and you'll find a lot of lenders that we've worked with for years that we get rave reviews from our members. So you can check out that, all kinds of investor resources. Okay. I'm not able to find any property with my previous criteria. Yeah, cash on cash return, it's changing. Price is going up, and now interest rates, which make cash on cash low. Nope, that's how it works. When prices go up and interest rates go up, you're going to have to readjust your expectations, and you're going to see lower cash on cash returns. What you want to look at is total ROI, right? So if you're cash on cash, if you're paying cash, it might not be as good, but if you're locking in a super low interest rate, it's pretty good. And especially if you were to look at the property 5 years from now, what would your actual ROI be? It might be better. It might be better than it's been. It might be similar to what it's been. But we can pretty much predict, based on what we're seeing, is rents going up and prices going up, in which case your ROI over time would go up. But that's speculation, and you got to do what's right for you. I wonder if some of the lower income job numbers is because of low wage jobs. Many people may have preferred to just collect unemployment. Yeah, I know a lot of people in that situation, because my daughter's a student. I mean, even students are getting this unemployment. So yeah, I think that's probably true. But I think that unemployment just got extended. Florida market has gone crazy in prices. Do you expect the same? We are, the bottom line is, when a lot of people want something that's in limited supply, prices go up, and that's what we're seeing. I still think, it's my personal opinion, the prices in Florida are still ridiculously cheap. just unbelievably cheap. They're almost as cheap as when we were buying in Texas 10 years ago. So I think there's still room to grow. You've got a lot of people from higher priced markets that go to Florida, and they're not going to say, oh, this house was $150,000 a few years ago. Now it's $200,000. They're not even going to think that. They're going to look at it and say, $200,000, that's a score. You know, oh my gosh, that's cheaper than the car I just bought in New York. So not that people in New York have cars, but you get my point. A New Yorker either renting a tiny studio for thousands of dollars, and they go to Florida and they find out they can rent a house for less, or they owned $1 million one bedroom or something, and they find out they can go to Florida and buy a luxury house for $300,000. I mean, you know, you're talking about still extremely affordable housing, especially when people are migrating there with higher salaries. So I don't think the party's over in Florida personally. And it's hard to build new homes. It's expensive. It takes years, and supply is down as more and more people move wherever they want to live. And Florida is a very attractive place to live. Do you think locking an interest rate now for a new home, which will be delivered in 8 months, is a good idea, or is it okay to wait for 7, 8? I don't know if you can even lock in a rate. I would talk to a lender, but if you are buying a house that's not going to be finished for 8 months, I don't know. Talk to a lender. I didn't think you could lock it in, and if you did, it might be expensive to do that. I don't foresee interest rates going up too much more in 8 months, but again, we don't know for sure. Is 5% cash on cash return is the new 8? It just depends on the market, and it depends on the property, but yeah, kind of. That's what we're seeing a lot of. But again, it depends on the property and the interest rate you can get and the rents you're going to get. And as rents rise, your returns are going to improve. Even though you can lock in a 30-year fixed interest rate loan and rents go up, would you say it's a concern that taxes and home insurance also go up? Yeah, that's something certainly to pay attention to. That's why we like to buy properties in low insurance areas, stay out of the flood zones. If you buy, you know, some people have been buying properties closer to the water just because they want to be close to the water, but the insurance rates are higher, certainly in Florida. So we like to stay inland and out of the flood zones, out of the long-term flood zones too. And we've actually found on new homes that insurance is pretty low. But yes, you do need to calculate that those costs could go up. Where is the best area to invest for cash flow for a new investor? Cash flow is getting harder and harder to find, but you probably want to stay in areas that don't appreciate as much. So that might be Ohio, although Ohio's been, prices have gone up so much there too. It's getting harder and harder. Probably Detroit might be the best cash flow. But again, some of these areas where rents are going up fast too, the cash flow might be better than it seems. So typically it's been the Midwest had higher cash flow, and the growth markets like Texas, Georgia, the Carolinas, and Florida had lower cash flow but higher appreciation. But again, where it's kind of mixed up these days, where we're seeing really high appreciation in the Midwest, but also in Florida and the growth states, and also seeing rents rise across the board. And it simply comes down to supply and demand. If there's nothing to rent, if there's nothing to buy, you're probably going to pay more. If I'm 66, does it make sense to do a 30-year loan or just try to do all cash? That's a very good question. We do a lot of RealWealth stories on the RealWealth show, and we have had quite a few people still lock in the 30-year fixed because it's a lower payment than, say, a 15-year. But if you want to pay that 30-year fixed rate loan faster, you can make extra payments. But if you don't have the funds or you need the cash flow now, you might want that lower payment. So just because it's lower payment would be a good reason to do the 30-year fixed versus a 15. But you could still make that 15-year payment on your 30-year fixed and pay it off early if you want to. But either way, yes, I would take advantage of low rates today as long as you have plenty of reserves in place. It just makes the cash flow better. Okay. Recommendations on holding property for a long time. If you're planning on holding property for a long time, it's my opinion that a new home is a better choice. So a lot of people might think, well, if I buy a new home, I'm not going to have as good a cash flow because I'm paying more for a new home, right? But what you're also getting is a new home. So you just don't have to deal with issues usually for a while. There's lots of warranties on a new home, and tenants love moving into a new home. So you can usually get it rented pretty quickly in good markets. So, I mean, I would want to know that I don't have to deal with a lot of repairs in my long-term investment. So either I would acquire a home that is renovated to like new conditions, or I would just buy a new home for the long term. Do you feel that more people with resale properties will place their homes for sale in the open market once things open up? You know, we'll see, but based on the amount of money that has been spent on renovation, on home renovation, I'm going to say I don't think so, because what we have are a lot of people who have locked in just ridiculously low rates. And if they were to sell their property now, where are they going to go? It's hard to find a replacement property or a new property. They're going to pay a higher interest rate. So seems that there's been a trend of people saying, you know what, instead of moving, I'm just going to improve where I live. So will there be more people wanting to sell their properties once they're vaccinated, and other people, you know, once they feel more confident about the pandemic? Yeah, there'll certainly be more people listing. But given the lack of supply, we really need that new inventory. So I don't see it as flooding the market with new inventory. It just seems to be getting gobbled up as soon as it's put on. Of course, it has to be priced right. You can't gouge the market, and you know, you don't want to put a piece of junk on the market, although some people do. They don't even bother fixing it up and they get a high price. So let's see. So yes, I do think more people will probably be willing to put their house on the market this summer, with the understanding that they would have to be able to find something else. And they're probably going to be paying more, higher payments, higher interest rates. So it's a tough decision, but some people do have to move. Maybe their jobs change, or they want to be there by their grandkids. So there's still people who will move. I mean, 5 million homes get sold approximately every year. So there's always sales happening. Do we have an affiliate in Columbus? You know, I'll look into that. We don't currently, I don't believe. Can you address the fact that Jacksonville team is raising prices for people that have already signed contracts? Okay, now this is really important to understand that with new homes, material costs have skyrocketed, just skyrocketed. And this is why we're going to see more inflation in real estate. Lumber prices have gone up 300%. You can't even get appliances. You have to wait months. Everything's taking longer. Prices are going up. It's very much pandemic related. Hopefully it will get solved soon. But in the meantime, builders have to up the prices on certain things. So we're seeing across the country, home builders having to go back to buyers and raise prices. So that is what's going on. Otherwise, they sell their property at a loss and they go out of business, and that won't be good for our industry either. So across the board, builders are raising prices to compensate for the out of control cost of materials right now. So that is just the fact of it. Ben said you cannot lock in a rate 8 months in advance. Thanks, Ben. I didn't think so. I mean, I've seen some banks do it, but you pay a big price for that. All right. Surprised you're not in Kansas City. You know what? We like Kansas City. We just need a good team there. So we're open to that. Oh, Baltimore. Oh, Ben, thank you. Ben says Baltimore has the best cash flow. That's great to know. Thank you. Hundreds of rental listings on Zillow for the Jacksonville area. Some of them are 60 and 90 days old. Are properties not renting? That's a very good question. I'll wait for Ben to answer that. I'm not sure why that would be, but there are, regardless of all the exciting and positive things I'm saying, it always still comes down to location. So there are areas that are less desirable than other areas. There are parts of Jacksonville that are growing, parts of any city that are growing, and parts of any city that aren't. So we are very much on top of getting in front of that growth, in front of the path of progress. That's where we're buying. But that could mean there's the opposite side of the city that is maybe losing jobs or isn't growing, or is older homes, or has more crime, or not as good as schools. So that may be why there's listings in those areas. Okay. Would you buy into a shared equity loan with no monthly payment and pay the percentage when you sell or take out a HELOC at a fixed rate? Ooh, wow. No monthly payment and pay the percentage when you sell. I don't know. I'd have to know more about that loan. Do you anticipate the rules being changed on 1031s and capital gains? I don't know, but my guess would be there'll be some kind of change. However, at the same time, we've had many administrations, including the Obama-Biden administration, that did not change the 1031. So there is a lot of understanding that there's a reason for tax benefits. And the reason is, as people get older, they have had these investments for a long time, and maybe they want to sell it and get something new and different maybe, and they don't have the funds to fix up the property. So the 1031 is actually, even though it's great tax savings for us, it's actually really good for the economy too. And that's one of the reasons it hasn't been taken from us. So we'll see. There has certainly been talk about changes, but it will be it will be difficult to get that passed, but you never know. So that's why I say don't buy property based on tax benefits. It is a benefit, and that's all. It's the icing on the cake, but the cake is still really good. Rates will be way up by December because of the recovery will be greater than expected. Maybe, but that's not what Fannie Mae is saying, and chief economist for Fannie Mae in the lending industry. So maybe, but that's not what some economists are saying. There is a large, but you should be prepared for that, and always ask yourself, what if rents went up a lot? Will this investment still make sense? There is a large inventory of condos in Northern California. Now that companies are starting to go back to work, do you think this may be a good investment? Anytime something's really cheap, it's something to look at, right? Anytime there's a lot of something, then generally, and not as much demand, then generally prices go down. And if there's a chance that demand would come back, then by all means. I don't personally like condos. I don't like the HOAs. I think by the time you pay the HOA and deal with all that, the HOA owners and everything, it's difficult. It doesn't really cash flow as well because of the HOAs. And you never know. You really got to understand if there's any deferred maintenance on the condos, because you could end up having to pay for that. And I've seen that happen. It happened on a condo we owned where we got tagged by the Coastal Commission for not having stairs down to the ocean. I just had an office by the ocean, and the Coastal Commission came in and said, you don't have stairs from this condo development down to the beach for the public, so it's a $11,000 fine per day dating back to the 70s or something like that. It's like all the condo owners had to pay that. So you just need to be aware of deferred maintenance on condos. I'm not a huge fan, but if it's the right price, it could make sense. Let's see, for maintenance reserves, where should they be kept? Your vacancy and maintenance and maintenance reserves can be kept in like a short-term kind of investment. We personally invest in private lending, but short-term, so we can have it liquid in 3 months. That's one way to do it. But anything that you can get access to fairly quickly if you do need to fix something or if you have a vacancy. When refinancing a rental property to a lower rate, would you usually advise to refi to a 30-year? Just depends on what your intention is for that property. Lenders joke that people always get the 30-year, but they refi within 10 years. So if that's true, then just get the 10-year if you're not going to hold it that long. I'm more conservative, and I just like getting the 30-year because it's still so cheap. It just gives me comfort. But if you're really just not going to hold the property that long, then get something cheaper, get a 10-year. Ocala is going crazy, but how long will it take for rents to catch up? That's a very good question. I'll wait for Ben or Tim or one of our investment counselors to answer that if they have any more insight. We were buying in Ocala in 2006 or something like that, and it was the sleepiest town, and then it's just been really growing. It's a very attractive place to live now, and well, it always has been, but now it's on the map. Generally, if there's more demand, as I said, more demand and not enough there, then rents will go up. So maybe there's too many rentals on the market that's keeping rents down, but as soon as that changes, and it will, then we would see rents go up. Any affiliates in St. Louis? I will leave that to Tim to answer. Do you think partnering with someone to buy one of your new construction rental properties is okay without establishing an LLC? Depends on how you put it on title, but I would definitely talk to an attorney would be the best way to make sure you are super clear on your partnership agreement, because that partnerships can get a little tricky. So just have your entire agreement in writing, approved by an attorney that you both sign, so there's no question about how you exit that, or if one person dies or the spouse inherits it, or the kids inherit it, like how are you going to deal with certain issues? And only an attorney can really look at all those possible options and make sure that you're safe for the exit. Are opportunity zones still a good investment, or has that ship sailed? I think they're a great investment. They're just extremely complicated. And I think prices have gone up so much in the opportunity zone areas that I'm not even sure it makes sense anymore. But if you can find a deal, it's a great opportunity. We just found it to be a little too complicated, so we didn't pull the trigger on it. I know you don't like condos, but what about smaller developments like 4 units or less with low condo dues? If you can get low condo dues and make sure there's not deferred maintenance that you're going to have to pay the bill for once you buy, make sure that you really look into that. A lot of times those HOAs have somebody on board. I don't know, there's got to make sure that there's no funny stuff going on. Like, and again, in our HOA, one of the people on the board was using his own company and inflating repair costs and stuff. And so I just don't like sharing ownership with other people I don't know. But with that said, if you can find a good deal, then go for it. All of that won't matter if you get it cheap enough. Any thoughts on getting a 7/1 ARM to take advantage of the lower rate? Again, if you're going to hold that property for short term, then go for it. Or if you think rates are going to go down again, then wait, you can refi later. I think most people think that won't happen, but it could. So it just depends on how long you plan to hold the property and what the difference is in rate. Okay, rents are great in Ocala. Properties there offer some of the highest cash flow that we see. Great. So glad to see that. Affiliates in New England, or is it too cold? It's too expensive. All right. Great. Well, that is it on questions, and we're right at the hour. So happy that you could be here with us. We're going to be here next Thursday with Ben, one of our investment counselors who's been with us for like 6 or 7 years now, and he's an experienced investor. He's going to be going over property management and answering your questions then, and that's going to be a really good time to bring your questions because he will have the answers most likely. And again, let's see if you're okay. There's more questions. I'll get to them later. Thank you so much for joining me here on our webinar. I'll be doing another update in 3 months for Q3, and it'll be exciting and interesting to see how that goes. Take care, everyone. Have a great weekend. Happy Easter. Talk to you soon. Bye-bye.